Hello. Good morning, afternoon, and evening, ladies and gentlemen, wherever you may be in the world right now. Thank you for taking the time out of your busy schedules to join us today with John Bubello as we present issues facing expats in America. I'm Aviel, better known as Avi, and I'm the financial administrator here at Dunhill Financial. Just a bit of housekeeping and a brief rundown of the format for this webinar before we get started. We will be putting everyone on mute as soon as the presentation begins. Please feel free to ask any questions in the chat and we will do our best to answer them for you as we go along. However, there will also be a Q&A section towards the end of our presentation for you to ask any questions you may have. Just before we start, a few disclaimers to go through. Dunhill Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Now with that out of the way, I shall hand it off to Brian.
Thank you, Avi, and welcome, John. Welcome, everyone. Today, we're going to be talking about the reverse of what we typically talk about, which is expats actually moving to the United States. And that's where it's really great to be working with John today and talking about this subject matter because it is a complete maze. Can you flip to the next slide? A little delayed approach on the intro, but essentially we have a full agenda of which we're going to be talking about several different topics and navigating the whole maze that we're going to be going through. So if we go to 2 slides later, there we go. The first thing that we really need to kind of go over is how did we get to this medley of acronyms that we're going to be discussing today. And it's all about how the IRS was able to try to go against tax evaders. As you can see, it became a bigger and bigger issue through the 2000s, all the way through to today, where essentially we had nearly $2 trillion of unreported funds globally to the IRS. And we ended up trying to go against all of those with the IRS by just going ahead and putting into place some of these new rules and some of these new aspects. That crackdown led to the closing of tons of accounts over at UBS, one of the biggest Swiss banks, of which most individuals ended up just being innocent bystanders that had a bank account with their retail unit. You might remember that that Switzerland used to have banking secrecy, and the United States was able to dismantle that all in one fell swoop as they moved over into new segments and to essentially get into place one of the biggest groundbreaking rules that has changed expat life, FATCA. FATCA has collected billions of dollars in revenue for the IRS. So even though there's a lot of organizations and a lot of people that say they want to dismantle it, we doubt that that would actually be the case because it has been extremely successful for the IRS in catching all these different tax dodgers and innocent individuals, which might include some of the people on this call that have things in the wrong place or might not be reporting them accurately. So what exactly is FATCA? Well, FATCA has been around since 2010. It really started in force in 2014, but it includes over 100 countries that are members of the FATCA Accords that essentially agree to share all information with the United States as long as the United States shares information with them. So it affects all US citizens, so people that sound like myself or John, but also any expats that become resident in the United States. So if you're spending enough time to become resident in the United States, everything we discussed today is subject to you following those rules. Even if you only have a green card and you leave the United States for a period of time, you're still subject to these rules until you turn in your green card. And it even pertains to you even when you have a second passport. The first thing that I want to discuss is the FBAR. The reason why it's nice to think about the FBAR at first is because there's no taxes associated with it. It is just a report that you have to file each year. The report basically states that if your aggregated accounts are larger than 10,000 US dollars at any one given time during the year, you have to report all of them to the Treasury through this FBAR report. So you can't have just a lot of small accounts and stay under that threshold. It's all of the aggregate of them. This includes business accounts. It includes any charities that you might be associated with that you can access their bank accounts, or anything else in between. So easiest way, keep all your accounts in aggregate below 10,000. You don't have to do an FBAR report. But if you go over 10,001 at one point in the year, you have to report them all, and you have to report the highest balance you had in the year. You'll notice that this is not the first time we talk about Bitcoins and cryptocurrencies in our different presentations, but you'll notice they're currently not on that list, but there's a lot of talk amongst Congress of including them going forwards. So don't think that that's the easy way to bypass any of the reportings of the FBAR. Again, no taxes are owed on this report or would be put together because of them, but there's severe penalties if you don't actually fill them out. The next thing we're going to be talking about, a lot of four-letter acronyms in here, are passive foreign investment companies. Now these become tough, and it becomes the body of why you want to start thinking about things in a more American-centric way, because any investment that's collectively put together outside of the United States automatically becomes a passive foreign investment company. This means if you have an exchange-traded fund that's traded any place outside of the United States, doesn't matter if it's Frankfurt, London, Shanghai, Hong Kong, any place, it is automatically a passive foreign investment company, or any collective that looks like a mutual fund or a UCIT or the such will also fall into this mix. If you own a PFIC, you will be taxed at a higher rate on your US taxes, either each given year as you report it, because you won't be able to offset the negative years, or at the end of the ownership, they will aggregate all of the growth, not offsetting the losses, which then pushes up your tax base on the US side of things. So we have never seen a time or an investment that is worth doing the PFIC election because it ends up being costlier on your taxes. And that's why we recommend not owning PFICs inside of your portfolio. So if you're just moving to the United States, there's a high probability that you want to sell your external investments before you get to the United States to convert them into US investments. If you've already gotten onto shore, you'll want to look at different strategies of how to get out of them or how to manage these. And that is something you'll definitely want to contact us. In our resources at the end of the presentation, you'll see some accountants' views on how these are put together. And therefore, we can look at strategies to how to get out of this. You'll always want to include real estate inside of your financial plan. And there's a lot of reasons why you want to buy real estate, especially when you're resident in America. The first one is really revolving around taxes. Any mortgage that you collect, you're allowed to actually deduct your interest up to $1 million and an extra $100,000 if you have a home equity line of credit. This gives you a nice tax write-off that you can offset your salary in the United States. And then the capital gains on the growth of that property can increase to up to $500,000 for a married couple, or $250,000 for an individual, to where you have no capital gains on your primary residence. You can even have a time period of 2 years in which you're not living in the property, that you're renting it out, and it's still considered your primary residence. So using these is a good opportunity to build into an asset class that's outside of your investments to build up your net worth. There's also other mechanisms if you have commercial properties or rental properties to where you can exchange one property for the same size or a larger property and offset those taxes, i.e. defer them through 1031 exchanges. So there's great means to buy, sell, build up your net worth with real estate if you like having those active types of investments in the United States. That doesn't work with any international properties. So if you have a property outside of the United States and you're moving to the United States, you might want to consider talking to a financial advisor prior to moving to the United States so that it's not subject to US taxes. And you're not going to be able to use that 1031 exchange rule. So taking care of things in order before you become a resident of the United States will be a good planning mechanism. You typically can't use pensions or the such to purchase a property. Inside of it, you typically have to make the distributions from it. So be careful with those types of exotic offerings that are out there. And if you do have a foreign property, we would typically avoid putting it inside of a foreign company because this can become very problematic on your US taxes. It can be different in certain civil law countries like Belgium or France, where you might have what are called Société Civile Immobilier. Those are partnerships instead of foreign companies, and those can actually just be looked through. But run those by your accountant, run those by your financial advisor before you move to the United States, before they become problematic on the US tax front. So if we've got our real estate pieces, we know what we shouldn't be investing in, but where should we be investing in? Well, we want to go ahead and have pretty much all of our investments on the US side of things. And there's 5 reasons why we recommend this. The first one comes down to the taxes. By not owning PFICs, passive foreign investment companies, we reduce our taxes significantly in the United States. And because the United States is the only country other than Eritrea that actually taxes on citizens' basis, you avoid your home country's taxes as well. So from a tax perspective, owning your investments in the United States will lower those taxes significantly. The second piece is receiving the 1099. Now, a 1099 is an end of the year document. It comes out around this time, sometimes more around February. And it makes filing your US taxes much easier than if you don't have that 1099. Most non-US institutions are not going to issue a 1099, making it so that you manually have to figure out that information for your US taxes. This could either increase the cost of putting together your US tax filing, or it could increase your taxes completely. The third reason is for the FBAR. Any accounts that are held in the United States, you don't have to declare an FBAR, and therefore we don't have to worry about reporting those. The fourth one is safety. The United States has a history since Joseph Kennedy, father of John F. Kennedy, setting up the first SEC and building structures like the FDIC and SIPC to make sure that any investments held in a bank or any investments held in a brokerage account are protected and ring-fenced from that firm going bankrupt. For example, in 2008, we had 2 very famous bankruptcies, Lehman Brothers and Bear Stearns. If you had your accounts in the brokerage channel at Lehman Brothers, they were just moved over to Barclays. Bear Stearns over to JP Morgan. Your assets were safe. They were volatile based on the values inside of the account, but they didn't disappear with the firms. That can't be said for every other country. A lot of other countries have the rules based on what the government looks at bailing them out. And therefore, that safety becomes a nice approach of being able to protect those assets. The last one is typically people's favorite ones. Most everything is cheaper in America, and the fees for the financial channels are much cheaper in America than they are in most countries all around the world. So those are the 5 reasons that we would recommend keeping your investments and moving your investments to the United States to get things going as easy as possible. Now, there's a lot of opportunities of investing in different ways in the United States. So I would like to introduce my friend, John Bubello, who we work with on several clients that are cross-border issues, to talk a little bit about how you can use retirement accounts and how they're fashioned in the United States to benefit you in the best ways possible.
Thanks, Brian. I love the fees conversation, but we'll leave that for another video, another conversation someday. But here in the US, just to kind of speak to this from a high level, which piggybacks on what Brian's already talked about, you have your investment or your brokerage account, of course, which is your taxable account that's taxed on a yearly basis based on interest or gains that you might take from a capital gains perspective. And then you also have retirement accounts, which, we love these because they come with a preferential tax treatment. So most assets in the US held by individuals, of course, there's real estate and other types of accounts, but you see most assets that are held by individuals are either inside an investment or a brokerage account is the term we'd use, or some sort of retirement accounts. And I wanted to focus on the retirement accounts today because they do come with preferential tax treatment. Now, on the next slide, we'll see that the two main types of retirement accounts, generally speaking, unless you work for a government agency or a nonprofit organization, you're going to see something along the lines of what's called a 401k plan. This is something that's sponsored by the employer. And everyone can contribute to the 401k plan. Again, generally speaking, the contribution limits are higher. And the nice part is that the employer, generally speaking, is putting in money to match some of your contribution. So the 401k plan is probably the main savings vehicle for folks that are here in the US. But there's other types of accounts where you can, as an individual, set up and complement what you might be doing in a 401k plan that's sponsored by a corporation, where it's an individual IRA. There are income limits. There are rules around it, but it's another way to put money away where you can get preferential tax treatment. And ultimately speaking, that's what these retirement accounts are all about. The government is helping you invest and save more money by either taxing you less or taxing you down the road in the future. And in the next slide, we talk about really the two different ways that you can make contributions to these different types of 401ks or IRAs. You can contribute money before it is taxed. Okay, that's pre-tax, or what might be called a traditional contribution. And that means you get a deduction from your ordinary income tax. You pay less taxes now, but down the road, hopefully in retirement, you're in a lower tax bracket. That's when you will pay taxes on those investments, but hopefully you'll be in a lower tax bracket in retirement. So ultimately you're borrowing money from the government, and then you're paying those taxes later on, but you get to invest it all along. You get to hold on to that money and invest it over for a long period of time. And then there's the post-tax contributions, where you pay taxes on those dollars, but they allow you to contribute them to a retirement account, whether it's a 401k or an IRA. That money can grow. And according to the laws right now, you never pay any taxes on that. And Roth contributions or Roth style accounts are very powerful from a longevity standpoint, and or even used for legacy concerns. They have a lot of neat features that make them very flexible and pass along or use assets later on in retirement. So they're incredibly tax efficient.
That's brilliant, John. Thank you for that. One more thing to think about when we're looking at retirement accounts is where you potentially might end up when you take the money out of those retirement accounts. Putting the money in, you're going to get great benefits to defer that tax buildup. If you move to a country like Canada or the United Kingdom, the double taxation treaty is pretty much seamless. Same thing for France. But certain countries like Germany, Spain, Hong Kong will actually tax distributions as if it's regular income. So again, something to plan for that you might look at potentially cashing out an IRA before you move out of the United States, or you might look at different strategies of how to manage them before you move back to your home country or any place else. And that might help determine how much you want to put away into these different plans. John gave you the maximum amount that you can put away into some of those plans, but sometimes you might want to look at minimizing them or changing those based on where you might end up in the long run. Now that brings along the conversation of currency exposure. Now, we've had a long period of time where we had dollar growth from about 2008, 2009 until last August. Before that, we had from the Nixon administration to the Obama administration where the dollar was pretty much going down. Most economists would assume that we're going to continue to have dollar weakness for a period of time, which means you might have to manage some of that risk in different ways. The first four ways that you can manage some of that currency risk is through future contracts, forward contracts, options, and swaps. Great ways of hedging things if, let's say, most of your money is sitting in a European bank account. You believe that the dollar is going to go down and you would like to lock in current rates. You can use those means for the purchase of a house or starting a business in the next year or so. But if we were to use those types of instruments for 30 or 40 years while we're building up a retirement plan, you would be making your financial advisor rich, but you wouldn't be doing much for yourself. So we want to look at other strategies, which include building natural hedges. The best way to think about natural hedges is with the next slide on how the breakup of the world is. Now, the world is broken up to where if you took all the market caps of all companies around the world, nearly 57% of them would be American. Now, the typical allocation, the typical US allocation will probably be between 75 and 90% US in the United States. John, would you say that's about right for an allocation?
Sorry about that. I'm on mute, but yeah, that's right there.
So essentially, the main reason for that is most American allocations are built for Americans that are going to retire in the United States. So by having a higher percentage than what the average market cap is, the financial advisor has naturally hedged you to the currency that you're going to retire in. Now, what does that mean? That means if you're not going to retire in the United States, you don't belong in that same allocation as the American or non-American that's going to retire in the United States. If you're going to retire in Europe, instead of having the MSCI Global's 14% in European securities, you probably want to have 35 to 45% in European securities. Or the UK, which makes up about 3% of the world as market cap, you probably want to have 30 or 40% in the UK if you're going to retire here. It becomes much more important when we have a cheap pound after 4 years of Brexit and an expensive dollar because we expect the dollar to go down. That's the basic concept of natural hedging and why it becomes so important. Now, I've been hinting at the values of different currencies around the world, but the most fun way of thinking about different currencies is by using the tongue-in-cheek indicator, the Big Mac Index. Now, the Big Mac Index came around back in the 1970s, and it was basically the economists looking at different ways that they could precurse the PPI index, the Purchasing Power Index. And it just becomes a much more fun way of looking at the values of all the components inside of a Big Mac, and therefore what they sell for in each given country to indicate whether their currencies are overvalued or undervalued. Now, 40, 50 years later, it's actually become a pretty widely used means of indicating what PPI is. And that's where, on the next slide, you're going to see that it doesn't matter if you're in an advanced economy or an emerging economy. The majority of countries are actually undervalued to the dollar. The dollar is expensive. The last 10 years are the perfect example of that. So if you look at 10 years ago, we had 7 strong currencies around the world. We had Australia, Canada, the United States, the UK, Switzerland, Sweden, and Norway. This was during the financial crisis, and essentially people were flocking to safety. People want to go into safe currencies whenever they see some problems in the world. And remember, during that point in time, the big conversation wasn't, is the UK going to leave Europe? It was, is the European Union going to fall apart? And then we had the Asian financial crisis, et cetera, et cetera. So people were flocking to safety. So these 7 countries became the places to go. In 2014, we had a commodity shock. Now, Australia and Canada are really commodity-rich countries. So they lost their strong currency policy and they became weak currencies around the world. So we were left with 5. Being here in London, Brexit is all around us. And the pound fell about 40% in the last 4 years compared to other relative currencies. And it's no longer considered one of the safe currencies to flock to. So during this pandemic of the last year, people flocked to 4 major currencies: Sweden, Norway, Switzerland, and the United States. And that is to where the majority of those assets went into the United States, because the other 3 are smaller economies. And that's why the dollar has had such a nice run over the last 12 years, is this flock to safety. As things go back to normal, we would expect that money to be redistributed back amongst all of the other currencies, making the currency basket a little bit richer, and the United States dollar a little bit poorer in that way. We use many different vehicles. We partner up with financial advisors like John to be able to offer all of our different portfolios in these different currency aspects. You can use them in your IRA strategies, your Roth IRA strategies, your individual accounts, or even into trusts and the like, whenever you want to. We break them down amongst 3 major currencies: the US dollar, the euro, and the British pound. Over 70 countries actually invested in US dollar, or using the US dollar as a peg. We like to use a lot of those clients in US dollars, but if you're going back to the UK or Europe, we definitely should be in those. We have them in Australian dollars as well for any of our clients that are going to Australia. And then we break them down into 6 risk profiles, from conservative all the way down to aggressive. You can see in this breakdown, where I was breaking down what a natural currency hedge is, that essentially the amount that we have in the US changes significantly from the US dollar model, where we're more like 70% US, to the euro model, where it's about level with the MSCI Global Index, and the GBP model, it's actually less than that amount. So you see how the currencies break that down. Now, some people will say, well, that guarantees that you're going to underperform, because the Euro 50 is underperformed the S&P 500, or essentially the FTSE 100 here in the UK has underperformed the S&P 500. We change that very easily by making sure that we have the breakdown of the correct sectors. In other words, the S&P 500 last year only outperformed other major indexes because 23% of it is made up of by 5 companies: Facebook, Apple, Amazon, Netflix, and Google, also known as the FANGs. If we even weight the entire S&P 500 last year, it was only up by 1%. So when you go into the UK or Europe, if we just take a market cap approach to everything and we just passively invest, we will end up having a portfolio that is actually going to do what the S&P 500 did last year if it was even weighted. So we change that up by making sure that we have the biggest proportions in the companies that are growing the fastest, so that we end up having that same exposure to technology and other good performing indexes at the right times, instead of just trying to say we're going to own the most of the biggest companies. put us heavily in banks and heavily in automotive companies over here. That's to where we can match that type of performance, but we can limit the risk of the currency. On our website, you can get access to all of our detailed reports for all 18 of those models. If you're looking for the Australian dollar models, you can just drop us a quick email. You can also find a quick risk assessment. And otherwise, John has his own risk assessment, and you can break down which of those different graphs you should go into. The next piece, we're going to show you a video of how we actually look at modeling risk. We do it on a core plus satellite approach, and I will let Isa and Cam tell you this story.
In 2007, Warren Buffett made a bet of $1 million that an index fund would outperform a collection of hedge funds over the course of 10 years. And of course, he won. With that said, the market often represents opportunities and risks that are hard to ignore. So how can I have my cake and eat it too?
What is core? The core of your portfolio is a bit like a tree trunk. Having a strong trunk will allow the tree to weather a number of storms and in turn continue to grow. This analogy does not only apply to trees in the forest, but can also be applied to your portfolios. A well-diversified portfolio will have a number of strong core positions that act as the trunk of the portfolio.
What are the satellites? Sometimes an opportunity in an individual stock, currency, or other investment presents itself, or even excluding a certain portion offers an opportunity in the marketplace. The key towards having good satellites is that they remain smaller positions of the overall portfolio, so that you don't lose your overall diversification. At Dunhill Financial, we keep all our aggregate satellite positions to under 20% of the portfolio at all times. And in normal times, we would prefer to have no satellites. I miss those normal times.
I miss those normal times too. We'll go through just a couple of resources and then we'll pass it over for Q&As. Essentially, one of the very important places to look before you hire a financial advisor is BrokerCheck. You'll get the entire background of that financial professional and any other information that you need to know. Double taxation treaties between your home country and the United States are very helpful to understand how the retirement accounts will behave, whether it be the US ones or the foreign ones, how your investments or real estate or anything else will work and who should be taxing them first and how much they'll limit the double taxation. You have three components of a double taxation agreement. One of them is for just regular taxes. The second one's for estate taxes, and the third one's for Social Security. If you lived in the UK, you have all three. If you lived in most European countries, you'll have a double taxation treaty. Some of them can be quite dated, going from before we had Roth IRAs or the such, and therefore they don't account for them. You typically have a totalization agreement, which essentially means even if you don't hit 40 credit hours in the United States or in your home country, that you can aggregate them so that you get a Social Security from both. So if you're only going to the United States for say 2 or 3 years, you want to be well aware of how this totalization agreement works, because you'll still be eligible for Social Security in the United States, even though you didn't meet that 40 credit hour requirement. 40 credits to receive it. But you have to contact the Social Security Administration when you're eligible for that. So being aware of those totalization agreements can be very helpful. A few articles on how our products work, how you can use them for say your UK ISA to make it compliant in the United States, or any of your UK SIPs and retirement accounts. So some nice resources there. I'll leave you off on one more video, which is for our economic update that's coming up. I think we're going to have some technical difficulties on that. We'll send that up in a follow-up email. But we do a quarterly economic update on exactly what we're doing in our portfolios. And our next one is coming up on March 31st. We'll send all of those in that series of updates. But from there, shall we open it up for any questions that anybody has in the audience?
So we have one question from Benoit Soroka, and he is asking, is the FBAR also mandatory for foreign students?
Anybody that's resident in the United States would have to fill out that FBAR. So yes, everybody that's resident in the United States has to actually perform on that.
That is all the questions that we have for now. Shall we give it 2 minutes if anybody would like to ask any more questions?
Absolutely. John, you don't have to run off, do you?
I'm here.
Perfect. John, have you seen any big changes this year?
Big changes. I love the comment of getting back to normal. And I wrote an email to clients recently that, yep, we're getting past the pandemic. Now we're just going to get back to normal reasons that everything's volatile rather than the exceptional reasons that everything has been so volatile.
You know, here in the UK, the Harry and Meghan interview on Oprah has hit the front page of every newspaper. And I can't remember any time in the last 4 years where it hasn't been politics, economics, or some sort of major disaster that's been the front page of the news. So we really welcome that. That seemed like normal times. Just gossip.
Gossip is back, and everything else can go to the back burner, hopefully, for a bit.
Exactly. You know, we have this groundbreaking $1.9 trillion stimulus that seems to have really helped the marketplace. That's coming out. Same typical arguments that you'd expect out of Congress and the Senate, but things seem to be moving back to a sense of normalcy. All the employment numbers seem to be coming out better than what we would expect. All the news seems to be moving forward.
Yeah, absolutely. So it's interesting. I mean, we're always thinking, guys like you and I are always thinking about what the next crisis is, and in a different email to clients, I talked a little bit about Bitcoin, Tesla, and also kind of GameStop activity. And when you mentioned Bitcoin before, Bitcoin reached what last month, or even it's approaching again $1 trillion in valuation. Mm-hmm. So there's a $1 trillion that has been created out of thin air. And, the question I receive is, can that $1 trillion disappear just as quickly? So with Congress passing a $1.9 trillion stimulus plan, if Bitcoin goes the wrong direction, 1 trillion to that 1.9 will disappear very rapidly from coffers in the US and, other investors around the world. So the numbers are just mind-boggling for most people. And we get into this idea of anchoring of what we got used to as children versus what the real numbers look like today.
Absolutely. I mean, I still remember the story of my father telling me that Pfizer had become a $1 million a year in revenue company. And we think of $1 million in revenue nowadays, it means absolutely nothing.
Yes.
But you're right. When it comes down to these cryptocurrencies, we said in our economic update that our favorite way of playing cryptocurrencies is, instead of betting on them going up or going down, betting on something like PayPal or MasterCard that builds easy ways to invest in cryptocurrencies. Because as you and I know, trading fees on stocks have gone down to basically zero. But cryptocurrencies, they're charging about 2% to get in and to get out. Yeah. So if one share costs $50,000 in Bitcoin, all of a sudden, PayPal or MasterCard's making $1,000 to buy one and $1,000 to sell one. And therefore it looks like Levi Strauss back in 1849. We don't remember any of the gold, the people that were involved in the gold rush. Now, all the gold in the world is worth $13 trillion. So it's not like gold has gone away, but none of those guys really came onto the purview of the radar. But Levi Strauss really made a name for himself. And that's why we'd rather look at the new Levi Strauss instead of trying to bet which cryptocurrency is going to work, which one's not.
Yeah. Yeah. We don't care who wins necessarily. We just want to be part of the process and help our clients benefit from it.
Exactly. Are you enjoying this whole new renewable energy push with the mention of Tesla and the likes?
Yeah, you get the same questions, of course, overseas that I do in the U.S., and that is the text message, the conversations from clients of should we get in now? And of course, it was last June in 2020 when, the idea that we may have a different president and those stocks started to move. So, the growth at any price sort of investing right now is a little bit rampant here in the US, where we have, companies trading at premium levels with the clear expectation that all these companies are going to be successful. So it's a fascinating conversation. I love the cars. I love the technology. I love the simplicity. But the markets seem to be ahead of where we are on a real business standpoint, a fundamental standpoint. So it'll be an interesting ride, and it shall be part of our story, 5 years from now.
Exactly. We know that we're never going to get bored watching Elon Musk push out all this information. Avi's telling me we have another follow-up question, so why don't we jump to that?
Thank you, Ryan, and thanks, John. So we have a question. Are expat students also able to maintain NHS benefits when studying in the USA for a couple of years? Does this fall within the totalization agreements?
That's a great question. And to be honest with you, I don't know the answer to that. I know in certain Commonwealth countries, like if you go from the UK to Australia, you're covered automatically with your NHS benefits using your UK passport. I don't think that works in the United States. I think you have to buy additional coverage. I'm not a healthcare insurance expert, so you'd probably want to consult with a insurance specialist on how you can go ahead and adapt them. Most travel insurance is only going to cover you for up to 90 days, but most universities will actually have some sort of a facility that you'll be able to reach out to them to get insurance as a student, healthcare insurance as a student. And that's the coverage that you'd be looking for.
With that concludes the Q&A part of the presentation. Thank you very much. Thank you, Brian. Thank you very much, John. Thank you all for asking questions.